You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And before I begin today, I want to just start by reminding you that there is a website that comes with this podcast. It's called wealthformula.com. And if you've not had a chance to go there, I highly encourage you to do so, because really that is, that's where there's a bunch of resources that we don't necessarily hit in the podcast itself. And it also gives you a chance to participate at multiple levels. In other words, there are various things that you can sign up for. There are webinars there that you can sign up for that are on asset protection, or maybe there's some tax stuff. There's books to download, et cetera, et cetera. It's also where you would sign up for the Accredited Investor Club, where, as you may know by now, that's where the magic happens. If you are an accredited investor, then that's where, all of this theoretical stuff that we talk about on this show really comes to life. And that is our private network, limited to people who are accredited. Now, who's accredited? Do you have to, take a test or something? Well, not really. Generally speaking, it's just a matter of whether or not you meet the criteria. The criteria generally are that you make $200,000 per year or more if filing by yourself, or $300,000 if filing jointly for at least 2 years with the reasonable expectation of doing so in the future, or you have $1 million of net worth outside your personal residence. If you meet those criteria, you are accredited. You aren't, it's like I always say, it's like you're either pregnant or you're not. You don't apply for it. You just are, you are not. And in this case, if you meet those criteria, you are. Now, there are some additional ways you can become accredited, and you may want to look those up. But I think if you get some various financial designations now, this is just in the last year, you get your series, whatever, whatnot, and then that counts as being accredited too. And if that's the case, then you can join as well. Obviously, I've not taken a lot of time to find out what that is. And that's in part because, listen, what we do does require fairly significant investments. And so, you generally do need to be accredited. You do need to have those financial, qualifications as well, as a general rule, I would say. Now, the other thing you can do, though, is if you are interested in, taking your education to the next level, and I'm not talking about just a flow of investments per se. I'm talking about, just working on your financial IQ, your acumen for high level financial strategy, etc. We do have a course called Your Roadmap to Real Wealth, and that includes membership into what we call Wealth Formula Network. Wealth Formula Network is really a phenomenal little private group that we have. There's probably about 90 people signed up for it, and it's not a very big group, but it's a very powerful group of individuals who are super into talking shop about personal finance. And if that is something that you'd like to do and talk to others, we do these bi-weekly Zoom conference calls. We do, we have a Facebook group, etc. Join the crew. I always say the best person for this is the person who likes to geek out on personal finance and strategies and all this investment stuff. But your friends and family, maybe your spouse is not interested in this stuff, so you end up not being able to talk to anybody. Well, if that's you, this is your perfect group. You can check that out at wealthformularoadmap.com. Now, as far as today goes, let's begin with that, and it is our first episode of the fourth quarter Ask Buck series. This started out as just sort of a random show once in a while, but we accumulate so many questions that I don't know how many Ask Buck shows we're going to have here for Q4, but it's probably going to take most of the rest of the year. And By the way, if you're curious, this is the kind of question answer stuff that we do in that Wealth Formula Network I just mentioned, except that it's not just me talking. There's a bunch other, there's a bunch of smart people who can add their take as well. So we'll get to a lot of these questions today, but I think it's going to be multiple weeks of it. And we'll start with the first set of these questions of Ask Buck when we come back from the following messages. Welcome back to the show, everyone. And again, this is the first episode of Ask Buck for the fourth quarter. And I don't know how many there's going to be. There'll probably be 3 at least, maybe 4. Who knows? We'll have to see. But this week, what I really wanted to do is to try to address questions for the most part that had, some level of time pressure on them. And as you can imagine, a lot of these questions are in about, end of the year tax planning and tax mitigation and that kind of thing. Now, and that being said, I should tell you right now, even though I talk a lot about this kind of stuff, I am not a CPA. So anything that I say, I don't want you to construe as tax or legal advice. I just, I'm telling you my own experience, and I happen to have a really good CPA in Tom Wheelwright, but anything I say, you should go through your own tax professional to make sure that those kinds of things are kosher for you as well. So with that, I'm going to start. There's a series of written questions. There's some that are MPEGs, and so we'll play those as well. I'm going to start with a question from Sean Adams, who Sean says, hey, been reading a lot of Buck's tax-saving ideas and love the approach for passive investing depreciation. I know these strategies are particularly most effective for business owners. Any advice or resources for high-paid W-2 employees? I've owned businesses in the past and deliberately returned to an individual contributor sales role because it suits me better. Keep up the tremendous content. Really enjoying it, Sean. Okay. Thank you, Sean. Appreciate that. And well, let me just start out by saying that when you say that you had businesses, but it suited you better to be, I guess, an employee, I do hope that, and I'm assuming you know this, but there is a happy medium between being a business owner, and having a bunch of employees and a W-2 income guy, because, as you know, even if you did sales, and I think you said you're in sales, but you did it as a independent contractor that got paid into an entity, you'd certainly have a lot more options than you do as a W-2 income earner. That said, I think it is a good time to review what options people do have this late in the game, with just really a couple weeks left in the 2020 year to really execute anything. And, just starting with what you talked about as a W-2 wage earner, well, what are the strategies that, are available to you? Well, you are right on when you say that they're pretty limited. They are very limited. But let's talk about some of the things that are out there, and I'll give you my 2 cents on that. I mean, there's oil and gas that's not controversial at all, in the sense that there's not any there's nothing that you have to worry about with the IRS or anything like that. If you invest in oil and gas, in many cases there's drilling involved, and normally. With these kinds of things, there is depreciation, but because of the whole bonus depreciation availability to us right now, you can take the full, in many cases, take the full amount of your investment and write it off in the first year. So I should point out that this type of bonus depreciation usually is not something that you can write off against W-2 income, but the oil and gas lobby is a strong one. I'll tell you that much. And, there's a lot of reason for, a very favorable oil and gas tax law, and a lot of it has to do with our own desire to become energy independent. We've certainly reached these kinds of goals where we're now a net exporter in this country. But, I think that's probably the big one that, I certainly have done it in the past when I initially got out of training and I had a lot of ordinary income. And some of it was W-2 as well. So that's an option. And like I said, normally bonus depreciation from investments is not something that can be used to offset W-2 income, but oil and gas is favorable in this regard. I would tell you that, I would refer you, if this is a topic that's of interest to you, on a recent podcast I did. It was the last one on oil and gas. Just go back a week or two, and it was Tom Powell, the founder of Resolute Capital, and we talked about it. And I think they're one of the operators in this area that I think is probably worth getting to know. And certainly, I should remind you, too, that I don't invest in oil and gas myself. I mean, I have the real estate professional designation, which allows all of my passive losses to offset active income as well. And that's because I spend most of my time doing real estate. And therefore, something like oil and gas that has, frankly, quite a bit more volatility, has quite a bit more risk, than our real estate projects, it's really just not that appealing to me. However, if I was a W-2 guy, I'd probably consider, something that had a structure like Resolute, a team like Resolute. And so again, I would suggest you go back and listen to that podcast a few weeks ago with Tom Powell. The only other real opportunity for offsetting W-2 income over the past few years for high net worth people has been conservation easements. And I almost I always kind of feel a little uncomfortable talking about conservation easements on the show because they are pretty controversial. The IRS hates them. So what are they? Well, they're a kind of charitable giving, so to speak, where you can essentially write off $4 or $5 for every dollar you put into it. So as you can imagine, you can get a pretty substantial type of write-off against all kinds of income, including W-2 income with this kind of thing. And in a lot of states, like California, even recognizes them so they can impact your state taxes. Now, again, the IRS hates them. We have, I'm not saying that you shouldn't do them, but I am definitely not going to tell you to do them either. I'm not going to give you any advice on this. In the past, I've been a little bit more neutral. I have participated, but there is enough IRS attacks and legislative flux this year where I would personally not feel comfortable with conservation easements per se. Now, if I really needed something like this, which I don't, because again, I have structured myself in a way where I am incentivized to invest in real estate, which is really awesome, frankly. If I really wanted to do something like this and need it, I would consider something similar to a conservation easement that we've talked about within Investor Club. If, again, it's another reason to join our accredited Investor Club. It's called a fee simple gift. And that is something that I think, if it were me, I would definitely not be doing conservation easements right now. I would be doing a fee simple gift because of the attacks and even the legislation that threatens conservation easements actually does not include talk about these fee simple gifts. So I think right now, if it were me, that's what I would be considering. I would not be doing conservation easements this year. So that's what I would tell you. Now, this stuff, again, is pretty complicated. All of this stuff, when I talk about with oil and gas, and certainly with conservation easements and fee simple gifts, et cetera, it's really stuff just for accredited investors. If you're not accredited, you're kind of out of luck, I think. And I should remind you again, if you're interested, you should join Accredited Investor Club, because this is the kind of stuff we talk about. We don't just have deal flow, but we also have educational webinars on this kind of thing. And we did have one on fee simple gifts. So if you're an accredited investor and you were trying to figure this stuff out, join the group. And if you missed the webinar, shoot me an email and I will get that link out to you for the replay on Fee Simple Gifts. So let me just end on this question by saying that my personal strategies for this year are really related to bonus depreciation and, well, more bonus depreciation. That is really my focus. So, I've acquired a lot of real estate with a lot of losses because of cost segregation and analysis and bonus depreciation. And I've also invested quite a bit in our WF Velocity ATM fund where you can take 100% of your investment and bonus depreciation first year. Now, we don't have any more real estate in Investor Club that is closing in 2020 so that you can get more bonus depreciation if you can use it. However, you can still participate in the WF Velocity ATM fund if you're an accredited investor. It's a Reg D 506C offering. And if you get your funds in by December 20th, you can still take 100% bonus depreciation on your investment. So go to wfvelocity.com if you're interested in that. But this strategy again is predicated on you having passive income. And I just want to reiterate something that I think will be an ongoing theme that if I can get people to really kind of digest, I think I'll be doing you a great service. That is, and in my opinion, I'm hoping where most of you focus your time is in the development or in the creation, I should say, of passive income. The cleanest, least controversial ways to mitigate your tax bill for the year is ultimately through strategies using passive income and taking passive losses against it. Even if bonus depreciation, if and when it goes away, and it will, you still have accelerated losses through cost segregation analysis, et cetera, that you can, really run on what we call this golden hamster wheel. So, passive income, just as a reminder, can be from ancillary income like surgical centers and infusion centers too. It doesn't have to be just from real estate. Obviously our ATMs are passive income as well. But, I think that I think it's really important. I think if you go back and listen to our most recent interview with Tom Wheelwright, where we really focused in on the concepts of creating passive income, that is where I truly believe that you should be spending your time if you can't be, a real estate professional, because you really need to build this thing that we call passive income. And many of you actually have it, and it has just not been recognized that. And in that case, sometimes you may need a new CPA. If you focus on creating passive income now, I'm going to guarantee pretty much that you're going to do yourself a big favor. That's not tax or legal advice. It's nothing. I'm just telling you, I truly believe that. It's actually something that you can actually ramp up pretty quickly if you can figure out how to do it. I have to tell you, just from my ATM machines alone, I've racked up 6 figures of passive income per year because the return is so rapid in terms of how quickly you get your money back in your pocket. Now, I have businesses where I also spend, very few hours per year that are passive in nature. There's lots of things you can do, and I know a lot of you are doing it, and some of you are doing it again. You've got passive businesses, but for some reason, your tax professionals are not counting it as that. It's very doable if you put your mind to it. So I'll leave it at that. Now, the next question is from Nick Sexton. Nick asks, when developing an entity producing an ancillary stream of income, so obviously this is a related question to our last topic, such as an ambulatory surgical center, X-ray, center or whatever, is there anything specific that needs to be legally declared or structured in the operating agreement or anywhere else in order to confirm the distributions will be considered passive for the stakeholders. The motivation, of course, would be to take advantage of the suspended passive real estate losses. And again, I think this is again a very important topic. And I should again preface this by saying I can't give you specific legal or tax advice. I can just tell you that the key is really what it comes down to is there material participation in the activity. So in my own case, I have a cosmetic surgery business in Chicago, and I don't practice in it. I live in California, after all. I'm on a call once per week. Maybe I get an occasional involvement in a marketing strategy or something like that. But all in all, it's probably less than 75 hours per year for me that goes into that business. And so it's passive. Now, you can check, and you should check with your CPA on what constitute material activity. But that's the key word, right? It's really, for the most part, these things are all about whether or not you spend material time, material activity in these, how much time you spend in these businesses. I mean, think about what the real estate professional designation is, making it an active business. 750 hours per year minimum, and you do nothing more actively. That's, essentially what a real estate professional is. So that's what makes something passive, which is most real estate investments, into something that's active. So think about the opposite of that. Again, I don't want to give you specific advice on this, but it's something you really should absolutely discuss with your CPA. And again, that is, for legal reasons, I don't want to give you any kind of advice. However, again, if you go back to the show that Tom Wheelwright was on a couple weeks ago, where we talked about passive income, we talked about ways to structure your businesses legally to take advantage of passive income that you may not be recognizing right now. And every medical business, for example, and I don't know if you're necessarily, I can't remember if you're a physician or not, but every medical business has medical equipment, right? And now, is there a reason why the equipment that you have in your office couldn't be owned by a separate entity where your primary business has to lease the equipment from? How about the same leasing company, acting as a marketing company, or maybe it does payroll and it gets paid for that? Anyway, listen, I don't want to give you any specifics here, but again, you are, when it comes to this stuff, I will just tell you that you are only limited by the limitations of skill of your CPA. And I've sent people to my CPA where he has literally saved them 6 or even 7 figures simply by restructuring what they are already doing in terms of people's businesses. And of course, Tom Wheelwright is not probably for everybody, but I would suggest contacting Wealthability in the Wealthability Network. Let them know, if you do, by the way, if you go to wealthability.com, that you're, with us, so that, you get a little extra TLC, because obviously I'm pretty close with Tom. So anyway, but going back to the basic question that you had about what is passive, I would just say, get the definition of an active business or, from your CPA, which should be the opposite of a passive one. And it has to do, again, primarily with material participation. And fundamentally, you got to ask your CPA, okay, what is it going to take for you to feel comfortable saying that this is a passive business? Because at the end of the day, it's your CPA who is filing your taxes and who's going to potentially represent you in some kind of an audit, right? So it doesn't even matter what I say in that regard. Okay, so hopefully that's helpful. The next question is from Jim McCracken, and Jim says, "Hey Buck, oil and gas drilling investments are popular this time of the year for investors with active income. What are your thoughts on its 3 to 5 year risk profile with WTI currently around $40? For example, do you see a $100,000 investment as a good bet with upside, or a significant risk given oil demand might never come back to previous levels? These funds typically have a 4 to 6 year hold horizon? Question mark. This is aside from the risk of hitting a dry spot and not finding oil. Thanks. All right, Jim. Well, again, not giving you financial advice here because, I'm legally not allowed to do that. However, let me just say this. I have never, to your question about, is there a good upside, good bet with upside? I have never, Jim, seen oil and gas investments as a good bet. I just haven't until I found Resolute Capital, again, Tom Powell's group. I wasn't even interested in interviewing anyone on the topic anymore because I really was concerned that people were just going to lose money as, I had early on. I mean, I invested in oil and gas probably a decade ago. And I got the tax write-off, but no, I never saw any money from that again. So, listen, here's why. First of all, there's volatility. I mean, you addressed that. We don't know what oil prices are going to be, especially right now. And so that creates an inherent risk. But right now, I will say that I think it's probably less of a concern, that particular issue of volatility. If you consider, a 3 to 4 year horizon, for example, and I know that's what I think Resolute really does, Tom Powell's group. So if you listen to that podcast, again, the oil and gas one I did with Tom a couple episodes, Tom Powell, about oil and gas a few episodes back, he talks about this. Now, Tom's a pretty smart guy. He's a really smart guy. So that's one of the reasons I, like talking to him on this topic, even though I'm not an oil and gas guy myself. But, there does appear to be a demand issue that's creeping into the picture, which and also a shortage in supply just from what happened in the last, several months, where it seems like prices will likely go up from where they currently are in the next 3 to 4 years, or certainly not go down. But again, it's all sort of speculation. So at that point, I think if you say that prices will, at least probably stay where they are or go higher, I think the bigger problem that I see with most oil and gas investments is that they operate on, this kind of heads we win, tails you lose philosophy, where, most of the oil and gas operators out there make sure they are heavily compensated up front and then go drilling, right? It's like wildcatting. And if they don't find oil, then well, at least they still got paid. And if they do find oil, then they'll split the profits with you on top of that, so they win and win again. This is usually not like real estate, where even if there is a promote, of course there's a promote, but there's also an underlying asset that has value that you are buying. It's not drilling for oil. Now, again, I should point out that one of the reasons that I have featured, Resolute on the show is because they are different. They buy many working wells, do some drilling, and essentially what their goal is to flip the wells like real estate. So they also have huge amounts of skin in the game, I should mention as well, because that's really important. They don't take upfront fees. I know Tom's got Tom Powell's personally got millions of dollars in these in what they're doing. So anyway, if I'm investing in oil and gas, which I'm not, that's probably that Resolute model is probably the type of model that I'd be looking for. I would just say that the vast majority of these oil and gas guys, especially those in the podcast ecosystem, are very concerning to me, and I would consider them radioactive at best. So Resolute is probably the only one that I'm not suspicious of. And again, it's, listen to Tom Powell on that podcast and, make your own judgment on that. Let's see. Let's move on to the next question. This one is going to be an audio question.
Yeah. Hi, Buck. This is Dave from Sonoma, California. Thanks so much for all the great content you continue to provide for us. I know you spent a lot of time in the past talking about the real estate professional designation and passive income gains versus passive activity losses. And I especially liked the recent conversation with Tom Wheelwright regarding asking the question, how can I convert at least some of my active income to passive income? It seems that either me or my wife getting the REP, real estate professional status, is sort of the holy grail here, because my understanding is it would allow us to offset active income from either of us with passive losses. So this year, I've been an active participant in some of Investor Club's offerings, and I'm expecting pretty significant K1 losses for 2020. But as I investigate ways to use these losses, other than just carrying them forward until I have passive gains, as in your golden hamster wheel analogy, which I realize is not a bad way to go, I seem to be getting some conflicting information. I've spoken with a few different CPAs, and I keep being told that, generally speaking, if I'm a limited partner in a syndication, that these losses will not receive ordinary income treatment, even if I do qualify as a real estate professional. That basically, once I have real estate professional status, I must actively participate in each activity in order to deduct the losses. So if this is true, this test would be hard for me to pass as an LP in a syndication investment. So I know you're not a CPA and can't give tax advice, but I'd just like to get some clarification on this point, and was wondering if you could speak to your interpretation of this. Thanks, Buck.
So Dave, as you mentioned, I'm not a CPA and I can't give tax advice. I have to keep saying that over and over again. Tom Wheelwright likes to remind me to point that out all the time, so I do. However, I can tell you that my CPA tells me that once you have established yourself as a real estate professional, and what I mean by that is that, again, you've got the material activity. You've got to have material activity. You cannot become a real estate professional just by investing in limited partnerships. However, let's say now you've got a few apartment buildings or whatever real estate, and you're racking up hours, etc. My understanding and what my CPA, who tells me, is that once you have done that, then your limited partnerships in real estate will go in that same bucket effectively as other real estate activity, and it's no longer just an issue of an LP thing. Now, as far as the LPs that you're currently in, before you have any real estate professional designation, my understanding is those are trapped as passive, passive losses. You can't go back and collect those once you have a designation. But what I'm telling you is that, again, my CPA, who disagrees with your CPA. However, again, LPs cannot make you a real estate professional. The REP designation has to be established by material participation, in which real estate LPs are not. But your question really becomes really relevant once you have established yourself as a real estate professional. I can tell you that there are many people in our investor community where they have established themselves as real estate professionals. And at that point, those LPs go in the same real estate basket, and the depreciation they're getting is used the same way as other real estate that they own as real estate professionals. Now, again, I think this is a very, very tricky CPA type question. You got to have a CPA who's very familiar with real estate. You got to have one who really understands the law. I mean, I think that in my case, Tom Wheelwright is a very conservative CPA, but conservative in the sense that he won't do anything he thinks is not legal. But you need to make sure that your CPA feels comfortable with this. And frankly, this is a situation where you may need to talk to a few different CPAs, because, well, if you have somebody who's telling you can't do something, whereas you've got a bunch of people around you who are doing it, and their CPAs say that you can do it, then you might need a new CPA. So hopefully that answers your question. I know it's not really an answer, but it is a way of telling you that I don't think that that you should settle for the answer, you can't do that. I think those are some of the more time-sensitive questions. I think there's So I'm going to move on to some other stuff that maybe not quite as time sensitive with end of the year stuff.
Hello, this is Craig Lessler Buck. I wanted to thank you for the podcast that you had, in which you had a hotel broker on your podcast, and he had made some recommendations of specific hotel stocks. Um, it was probably 2 or 3 months ago that you had him on the podcast. I have a 457 plan, and I did use the CARES Act to take out $200,000, $100,000 withdrawal plus $100,000 loan, but the rest of the money that was in there in my 457 plan has to stay with the plan because I'm still a state employee, and it's self-directed, but only in the stock market. So I was able to take your recommendation and put it into those 3 hotel stocks, and those hotel stocks are up. Apple, and I forgot the other one, the third one, but they're up tremendously. So I just want to thank you for that.
Well, Craig, I'm glad to hear that worked out for you. Again, that was if you go back, I can't remember what number it was. It was basically it was an interview called "Should You Invest in Hotels?" It's something I think is something that is worthwhile in the future. And I think what's interesting about that is that, I had this guy on the show who's a broker here in California. And, he's a really good guy. He has helped one of my friends who's a hotelier who's very successful with developing his portfolio. And the funny thing about it was I had him on there, and a lot of times people, try to sell their services, and, they basically are looking for clients. And when I asked this guy, Steve, if he, if what he recommended right now, he basically said, well, right now it's tough to get any lending on these things because of COVID, et cetera. But I'm looking at these stocks, which were basically REITs that just got crushed with COVID. And he said, if it were me, that's how I would invest in these things right now. And that was really nice of him, right? I mean, and I think that's one of the powerful things about the guests and people in our community that we have in this show is a lot of time we just have people who are just really good at what they do, and they give you real information. And, he was honest. He could have just told you, hey, come call me and we'll figure something out. But he was like, well, probably the smartest thing is just to buy these REITs. And he gave names of 3 REITs, and it sounds like it did really well for Craig. So I'm glad that worked out for you, Craig. Worth the price of admission on the podcast, I guess. All right, next question.
Hello, Buck. My name is Jinhee Park, and I'm a physician. I've been listening to your podcast for about a year. Thank you so much for the great information. It's been about 5 years since I got out of my residency training, and I still have about $160,000 of student loan debt at about 5.875% interest rate. Supposed to be paid off in 20 years, and I think about 17 more years left to go. After listening to your podcast and reading Rich Dad Poor Dad, I got into real estate, and this past year, I sold some of my rental properties, and I got into about 6 commercial syndication deals and some multifamily and then self-storage investments. And I have the option, after selling a single family home, I have the option either to get into 3 more syndication deals by the end of this year, or to completely pay off all my student loans. And I'm debating which one is a better option right now, because the syndication deals that I'm looking at, they say, well, the annual return will be about 20%, 17 to 20% annualized return for the next 5 years, which sounds great. So if that turns out to be, real, then it'll be worthwhile going for the syndication deals instead of paying off my student loans. But at the same time, I also it's a risk getting into any kind of investment, because there's a chance that I might just lose money because I'm giving my money away to people who are going to be controlling the asset. So I keep on going back and forth. Should I pay off my student loans completely and, start from zero with peace of mind, or should I take advantage of this opportunity that I made this sale of my single family home? I have a big chunk of cash that I can just use to pay off my student loans and be done with it. So um, I'm sure a lot of other physicians who've been through med school who took out student loans have the same debate in their mind. So if you can answer this question for me and also for other physicians, I would really appreciate it. Thank you.
Well, again, Ginny, I would just say that, it's a tough situation because it's, an advice question. And it's hard for me to give people advice because I think, and I think there are legal ramifications, et cetera, and all that. But let me put myself in your position and let me tell you how I'd be thinking about it. Generally speaking, and I was in this position where I had student loans, et cetera, at one point. For me, what it really came down to is math. Did I believe that I could take the money and actually get a better return from my investments than the interest rate that I was paying on the loans? Now, actually, my interest rates, I believe, back when I had them were lower than 5.875. That's pretty high. But I think that's really what I would be contemplating in my mind is, can I invest and beat the interest rate confidently? So what would I do? Well, what did I do? Well, I did invest in real estate. I did get far better returns, and eventually just kind of, slugged out those student loans because they seemed fairly insignificant. They became a nuisance more than anything else. But I used my dry powder to try to create capital rather than to pay down debt. Now, obviously, that is a controversial approach, but I am not exactly, I'm not typical in terms of, what people say about this stuff. I'm not the guy who says erase all your debt first because, I think that there is a tremendous, power in being able to use your cash to create more cash. But I do think if you focus on it in terms of, do I think my returns will be better if I invest them than in, the interest rate that I'm paying? I think that's a good way to think about it in general. I personally, let's just take, for example, the ATM stuff that we've been talking about. I mean, it's a good example where, there's again, it's a Reg D 506C, credit investor limited thing, but you've got essentially a over 22 point something percent per year, fixed return for 7 years. To me, that ends up, the internal rate of return on that ends up, far exceeding the 5.8%. I mean, that is something that pays on a monthly basis. For me, I'd probably be looking at something like that, looking at something with cash flow, looking at real estate and projects that are going to give me good returns and that have some cash flow so that I can pay off those loans as they come. That's kind of what I would be doing. But again, I don't want to give you advice per se, but think about it this way. Think about it as anything else. Like, can you do better than 5.87% with your investments? And if the answer is that you can do 10%, well, then, you're paying your 5.87 and you're taking another 4% home. So that's how I look at it. But, everybody looks at this stuff differently, I think. Okay, I think we have time for one more question on this week's Ask Buck.
Hi, Buck. This is Peter from New York. I want to thank you for all the great content and the great investment opportunities you brought to us. My question is a bit of a follow-up from some things you previously discussed around being a real estate professional. I know I'm not a real estate professional, and my only passive income is from these types of investments. So the losses they generate, I can only use to offset income from passive investments. And as a result, I can't use all the losses every year. But from my research, it looks like those losses can be carried forward to future years so that they can be used on an ongoing basis, and especially in the year where the investment is sold, likely generating a very large gain, those carry forward losses could offset that. So while I can't get the immediate benefit a real estate professional can, it does seem like I won't lose the losses and will ultimately be able to use them and not get burned in the end. I just wanted to see if that was consistent with your thinking, and it's hopefully not as bad as I thought it might be. Thank you.
Good question, Peter. That is, listen, it's, I'm not a CPA, but I'll tell you that I'm about 100% sure that your losses in these things carry forward indefinitely. Basically all of the losses that you're accruing vis-a-vis depreciation, et cetera, in real estate or whatever, they don't just magically disappear. Eventually, you're gonna use them. And the funny thing is that in some cases, you might even try to accumulate these kinds of losses, even though that you're not going to be using them in the same year. Now, let me give you an example of that because it might be relevant to some people. We know, for example, that bonus depreciation is set to expire in 2022. And we also know that there's probably a pretty good chance, well, almost a guarantee, if the Senate is overturned back to the Democratic Party, that will be reversed very quickly, and there will not be, this unlimited bonus depreciation, perhaps as early as sometime early in 2021. We'll see. But certainly by 2022, it's set to expire anyway. So there's a good chance we won't have it anymore. So right now, because of this bonus depreciation provision, we are able to deduct a significant portion of our real estate investments like you've done because of cost segregation analysis and bonus depreciation. I should point out again that the ATM fund that's still open for 2020 depreciation also allows you to take 100% of your investment as bonus depreciation in the first year. So even if you're not using it this year, you may say, well, if I accumulate big chunks of those losses now, I might not be able to accumulate them as quickly as I need them later when you have passive gains that you want to write off. So again, going back to the idea that we all really should be focusing on essentially one of two things. Either, you become a real estate professional and you're able to, activate all these passive losses vis-a-vis real estate and, use them against all your other active income. That's one thing. That's not where most people are going to be because most people simply don't have the ability to give up their job and become full-time real estate people. But if the other option is to build that, that passive income bucket. And I hate the word bucket in this regard, but that's really the way you look at it through all of the ways that we've talked about, several times on this show, whether that's, accumulation with dividends through real estate or ATM machines or something like that, or, more potentially with greater acceleration if you can figure out some business activity or take part of your business and realize, hey, that's been passive all along. There are so many opportunities here to build passive income. I really think that that's what we need to be doing. That's what everybody in our community probably should really be focused on and thinking about how do we do this? Because listen, there's always these tax strategies, and sometimes they're pretty controversial, as we talked about when it comes to conservation easements. Sometimes they're like oil and gas, where you're like, yeah, but I don't know if I really want to invest in oil and gas, and so we just let the tax, let the tax wag the tail, so to speak. And doing something better than that would be to actually create income and then allow your investments that you want to do, like in real estate, and let those losses actually become active and use them because you have enough passive income. That's where we ought to be focusing. That's where everybody, I think, who's listening ought to be focusing. And hopefully we can continue building on, that conversation in the year to come. So anyway, that is it for questions this week. We will be right back. Welcome back to the show, everyone. And that was it for round one of Ask Buck. I do want to thank all of those who have submitted questions. We have a lot of them still. So if we didn't get to yours yet, do not fret. We will do so in short order. But I did want to make sure that we got some of these time-sensitive questions in. That's why this one, I think, was so tax-heavy. With that said, I do want to also remind you that if you like this kind of setup, a lot of, questions and answers, and you're learning a lot from that, I do really want to, again, remind you that there's something called Wealth Formula Network. Wealth Formula Network is, it's kind of an offspring of our course, Your Roadmap to Real Wealth. If you go to wealthformularoadmap.com, you can check that out. And you basically get membership in Wealth Formula Network with that course. So that sort of builds a foundation, and then you can interact with others who are in that network. It's a virtual community. There's probably just under 100 people in there right now, and we have these bi-weekly Zoom mastermind calls. We have a Facebook group and stuff. People really enjoy it, so I would check that out. The last thing I will mention is, if you like the show, again, make sure to go to wealthformula.com and there's a link there where it says give us a 5-star review. If you think we earn it, do it. Subscribe to the show. That's what helps us move up in the rankings. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.